The Korean won currency is under pressure. Rates are moving back into the center of the story, and the easy chase in Korean equities is getting dangerous. At the same time, US megacap software may still have one more window of relative strength. So, the real question is simple. Where is the last durable liquidity? And where should investors stop chasing? Welcome to Dragon Bullion. This market is not just asking whether good companies are still good companies. It is asking whether the current price, the current currency backdrop, and the current rate cycle still give investors enough reward for the risk. That difference matters. Samsung Electronics and SK Hynix can remain important. High-quality Korean semiconductor names, while the trade around them becomes much less attractive after a strong run. The KOSP I can still contain excellent businesses, while the index itself faces a tougher setup if the Korean won currency weakens again, and domestic liquidity stops flowing into equities. For US investors, the message is not to ignore Korea. The message is to separate the company story from the macro entry point. If the $1 exchange rate is moving back through the 1,501 zone, and investors start discussing 1,550 or even 1,601 per US dollar. Korean equities are no longer just a simple earnings story. They become a currency, rates, and liquidity story at the same time. This is why the next trading session should be watched through 3 filters. First, whether the Korean won choke currency stabilizes or keeps weakening. Second, whether rate expectations in Korea, Japan, and the United States begin to rise together. Third, whether US software and platform leaders keep absorbing capital while semiconductor enthusiasm cool. Start with the exchange rate. The $1 exchange rate is the cleanest stress gauge for this setup. When the $1 exchange rate is in the 5,501 area and fails to move lower, foreign investors see currency risk, domestic consumers face imported inflation, and the Bank of Korea faces pressure to defend price stability. The key level is not just one print. The key is whether the market accepts the 1,501 area as stable or whether the move opens toward 50-minute, 50-minute, and then 50, 60, 1001. If the exchange rate keeps moving higher, the pressure on Korean equities can grow even if individual companies still report decent fundamentals. That is why a weak Korean won currency can change the entire interpretation of a rally. A semiconductor rally during a stable currency environment can be treated as a growth trade. A semiconductor rally during a weakening currency environment has to be treated more carefully because the same price move may be funded by domestic capital trying to escape cash weakness rather than by broad global confidence. Investors should not read a bounce in the KOSPI as proof that the risk has passed. If the $1 exchange rate remains elevated, the bounce can become a selling opportunity for late entries. The healthier signal would be different. The won stabilizes below the 1,500 zone, rate expectations stop tightening, and Korean semiconductor volume improves without depending on currency fear. The second signal is rates. A geopolitical relief headline can feel bullish at first, but the market reaction after relief is often more complicated. When emergency pressure fades, governments and central banks can return to inflation, fiscal cost, and rate normalization. For Korea, the issue is especially sensitive. In a normal environment, Korea usually needs to offer enough yield to compensate investors for currency and domestic risk. But in recent years, the United States has often carried the higher rate structure. That gap can survive when Korean earnings are strong and domestic money is moving into equities. It becomes harder to defend when currency weakness starts feeding inflation. A 0.25 percentage point hike in the United States and a 0.25 percentage point hike in Korea do not solve the spread. The difference is still roughly the same. If Korea wants a stronger currency effect, the tightening path may need to be longer or stronger than the US path. But Korea also has limits. Household debt, real estate sensitivity, and political pressure make a sudden 0.50 percentage point move difficult. A more realistic path is a long series of smaller 0.25 percentage point adjustments. That kind of cycle does not always create one dramatic crash. It can create a long, frustrating valuation pressure, where rallies fade and investors keep reducing risk into strength. This is the risk investors need to respect. If the Bank of Korea tightens and the Korean won currency still does not stabilize, the market can move into the worst interpretation: tighter policy without enough currency relief. In that case, chasing Korean equities after a strong run becomes a low-quality risk trade, not a disciplined entry. The third signal is supply and demand inside Korea. It is easy to focus only on foreign buying, but the recent Korean move cannot be explained by foreign investors alone. Domestic capital has been important. When the Korean won currency weakens and real purchasing power feels unstable, large domestic investors do not always stay in bank deposits. Some of that money moves into equities, especially into names that feel like national champions or global technology winners. That is one reason Korean semiconductor shares can move powerfully, even when the macro backdrop is not clean. This can look similar to the kind of asset price behavior Japan experienced after long periods of very low rates. When cash feels like it is losing value, wealthier investors often look for equity and real asset exposure. That flow can create a strong market, but it also creates a fragile market if the reason for the flow changes. If the Korean won currency begins to strengthen and Korean deposit rates become more attractive, part of that domestic capital can move back toward banks, bonds, or cash-like assets. Foreign buying may still help individual names, but it may not be enough to carry the whole KOSPI if domestic liquidity starts leaving the equity market, so the practical check is simple. Do not only ask whether foreigners bought Samsung Electronics or SK Hynix on one session. Ask whether domestic turnover, institutional demand, and high net worth flows are still supporting the trade. If those flows weaken while the $1 exchange rate remains elevated, the index can lose momentum quickly. Samsung Electronics and SK Hynix remain central to the Korean market. They sit at the intersection of memory, AI infrastructure, and HBM demand. Nvidia capex and AI server demand still matter for their earnings narrative. None of that disappears because the macro setup gets harder. But a good company is not automatically a good buy at every price. That is the point investors cannot skip. A long-term position built at a low average cost can be held with a different mindset from a late position opened after the move has already happened. At this stage, the upside and downside have to be measured realistically. If an investor is chasing the trade now for another 10 to 20%, that investor is also accepting currency risk, rate risk, and flow reversal risk. That is not the same risk-reward as buying during a panic when earnings expectations remain intact. The cleaner strategy is to separate positions. Low-cost, long-term exposure can stay as long as the thesis remains tied to real AI semiconductor demand and not just momentum. Late entries should be managed much more aggressively. If there is a rebound without currency stabilization, partial reduction is a rational response. The buy condition is also clear. Samsung Electronics and SK Hynix become more attractive again. If the pullback is driven mainly by macro stress, earnings expectations remain intact, and the Korean won currency stops sliding. If those three conditions are not present, patience is more valuable than speed. The US market can behave differently from Korea. If the Federal Reserve keeps rates on hold while Korea and Japan face more pressure to normalize, US equities can still look like the last large pool of relative liquidity. That does not mean the US market is risk-free. It means the timing can be later. This is why US investors should not treat every global tightening signal as an immediate sell signal for the S&P 500 or Nasdaq. If money leaves more vulnerable markets first, US mega-cap platforms can still receive support. Apple, Microsoft, Alphabet, and Amazon can act as liquidity magnets when investors want earnings visibility and deep market depth. The leadership inside the US market matters. If the only strength is crowded semiconductor momentum, the rally is less healthy. If software, cloud, digital advertising, enterprise platforms, and profitable mid-cap software names begin to participate, the market has a broader late-cycle rotation. That is the window to watch. US software can outperform Korean semiconductors if investors are moving away from currency-sensitive cyclicality and toward recurring revenue margins and balance sheet strength. The market may still climb, but the quality of the leadership has to be checked every session. The risk is Japan. If the Bank of Japan does not just hike once, but signals a sustained hiking path, the yen carry trade becomes a real global liquidity risk. In that case, capital that had been comfortable sitting in US assets may start to reprice funding costs. That is the point where the US market can stop being the safe relative trade and become part of the global adjustment. Bitcoin and altcoins should be treated as liquidity signals here. When rate hike expectations rise, crypto often reacts early because it depends heavily on abundant liquidity and risk appetite. The important point is not that Bitcoin can never recover. The important point is that a falling Bitcoin market during a rising rate discussion is not just ordinary profit-taking. It can be the market telling investors that liquidity is getting tighter before equity investors fully admit it. Altcoins are even more sensitive. They can fall harder than Bitcoin because they usually have weaker liquidity, thinner demand, and less institutional defense. Ethereum and other major crypto assets may still have long-term believers, but that does not justify aggressive lump sum buying when the rate and currency backdrop is tightening. The practical condition is this: crypto exposure should be small, staged, and patient until Bitcoin stops making lower risk signals and liquidity improves. If Bitcoin keeps weakening while rate expectations rise, aggressive buying in altcoins should stop. The better entry is after the market shows that the tightening fear has been absorbed. For equity investors, this matters even if they do not hold crypto. A weak crypto tape can warn that speculative liquidity is leaving first. If that weakness spreads into high beta equities, Korean semiconductors and crowded AI-related names can face sharper profit-taking. WTI crude oil is another important checkpoint, even when it is not the main trade. Energy prices affect inflation expectations, central bank communication, and currency pressure. If WTI rises while the Korean won currency weakens, Korea imports more inflation pressure through both oil and FX. That combination is difficult for the Bank of Korea. Higher energy costs push inflation pressure up. A weaker currency makes imports more expensive. If policymakers respond with rate hikes, equity valuation pressure rises. If they do not respond, the currency can remain weak and imported inflation can stay uncomfortable. This is why oil, FX, and rates should not be checked separately. A stable WTI backdrop with a stabilizing Korean won currency gives Korean equities breathing room. A rising WTI backdrop with the $1 exchange rate pushing toward 1,550 or 1,601 creates a much tougher risk environment. For the United States, WTI also matters because inflation pressure can challenge the Federal Reserve's ability to stay patient. If oil prices rise and inflation expectations firm, the market may have to reconsider whether the Fed can keep holding rates steady. That would reduce the relative advantage U.S. equities currently have over more rate-sensitive markets. The cleanest bullish mix would be lower oil pressure, a calmer $1 rate, and no fresh hawkish surprise from the Fed, the Bank of Korea, or the Bank of Japan. Without that mix, investors need to keep position sizes disciplined. The bearish scenario is not complicated. The $1 exchange rate moves above 1,551 and the market starts pricing a path toward 5,601. Korea raises rates, but the currency does not respond. Domestic investors begin moving money back toward deposits or bonds. Samsung Electronics and SK Hynix bounce, but volume and institutional demand do not confirm the move. At the same time, Bitcoin keeps weakening. Altcoins sell off harder, and WTI adds inflation pressure. The Federal Reserve stays cautious at first, so U.S. equities hold up for a while. Then the Bank of Japan signals that rate normalization is not a one-time move. That is when the yen carry risk can reach U.S. assets too. In that scenario, investors should not treat every dip as a buying opportunity. The correct response is defense first. Reduce late-cycle Korean equity exposure. Protect gains in crowded semiconductor trades. Keep more cash and wait for the currency and rate signals to improve. The opposite scenario is also clear. The Korean won currency stabilizes below the 3,500 zone. Korean rate pressure looks manageable. WTI does not add new inflation stress, and U.S. software leadership remains strong. If that happens, the market can digest a prior rally without a major breakdown. That is why the briefing is not bearish for the sake of being bearish. It is conditional. The market can recover, but the recovery needs confirmation from FX, rates, flows, and leadership. Price alone is not enough. For Korea, aggressive buying should wait until the $1 exchange rate stabilizes below the 1,501 area and the market accepts that rate hikes are helping inflation credibility. If the won is still weak and policy is still uncertain, buying the KOSPI aggressively is premature. For Samsung Electronics and SK Hynix, a better buy setup requires a pullback that does not damage the earnings story. Investors should want to see AI memory demand, HBM expectations, and foreign institutional volume remain intact, while the macro pressure begins to fade. Without those conditions, late entries should be reduced into strength rather than expanded. For U.S. equities, the more selective opportunity is in profitable software, cloud, and platform leaders. The U.S. market can be held longer than Korea if the Fed remains on hold and megacap earnings continue to support the index. But if software leadership breaks and only defensive megacap buying remains, the window is narrowing. For Bitcoin and Ethereum, small staged exposure only makes sense after the market stops falling on rate fears. If Bitcoin keeps weakening, altcoin risk should be cut back, not increased. Liquidity comes first. The reduction conditions are just as important. Reduce Korean equity risk if the $1 exchange rate moves above 1,551 or opens a path toward 1,601. Reduce late semiconductor positions if rebounds come without stronger volume and better FX. Turn more defensive on U.S. equities if the Bank of Japan signals sustained hikes and the yen carry trade begins to unwind. The next trading session is about confirmation, not hope. Watch the $1 exchange rate first. If the $1 exchange rate calms down, Korean equities get room to breathe. If it keeps climbing, the pressure remains. Watch the Bank of Korea's language on inflation, rate speed, and currency stability. A small hike path can still pressure equities if the market thinks the central bank has to keep going for a long time. Watch the Federal Reserve. If US policy stays on hold, US software and platform names can maintain relative strength. If inflation pressure forces a more hawkish tone, the US advantage weakens. Watch the Bank of Japan. A single move matters less than guidance. Sustained tightening guidance is the risk that can turn a Korea-centered adjustment into a global liquidity event. Watch domestic Korean flows. Foreign buying headlines are not enough. The KOSPI needs real domestic support, turnover, and institutional confirmation. Finally, watch leadership. If Samsung Electronics and SK Hynix rise with strong volume, stable FX, and intact earnings expectations, the pullback can become an opportunity. If Apple, Microsoft, Alphabet, Amazon, and profitable software names keep leading in the United States, the US market can still hold up longer. If both leadership groups fail while Bitcoin and altcoins stay weak, defense has to come first. The market is not telling investors to abandon every good asset. It is telling investors to stop paying any price for a good story. In this environment, the best trade is not the loudest trade. It is the one where currency, rates, liquidity, and earnings all point in the same direction.